Are you losing money without even realizing it? Inflation is a silent force that can slowly erode the value of your hard-earned savings and investments over time. Have you ever stopped to think about how inflation might be impacting your financial future? In this video, we'll explore the impact of inflation on your savings and investments and provide you with actionable strategies to protect your wealth from its insidious effects. What is inflation and why should you care? Inflation is the gradual increase in the cost of goods and services over time. As prices rise, the purchasing power of your money decreases. This means that the same amount of money will buy you less in the future than it does today. Imagine having $10,000 stashed away in a savings account that earns a modest interest rate. If the inflation rate is 3% per year, the real value of your savings will decrease each year. In fact, after just 5 years, the purchasing power of your $10,000 will be reduced to around $8,500 in today's dollars. This erosion of purchasing power can significantly impact your ability to achieve long-term financial goals, such as saving for retirement or funding a child's education. Inflation can be caused by various factors, including an increase in the money supply, rising production costs, or increased consumer demand. When the cost of living rises, it becomes more challenging for individuals and households to maintain their standard of living, as their income may not keep pace with the rising prices. This can lead to a decrease in real wages and a reduction in overall purchasing power, making it harder to afford essential goods and services. The hidden erosion of purchasing power. Inflation doesn't just affect your savings accounts, it also impacts your investments in stocks, bonds, and real estate. If your investment returns do not outpace inflation, you may find yourself in a situation where your investments are not generating real growth or even maintaining their original value. This hidden erosion of purchasing power can be particularly damaging for those who rely on their savings and investments to meet their financial goals, such as retirement or funding a child's education. Even if your investments appear to be performing well on paper, the real returns may be much lower when factoring in the impact of inflation. For example, if your investment portfolio earns an 8% return in a year when inflation is 4%, your real return is only 4%. Over time, this can significantly impact the growth of your wealth and your ability to maintain your desired standard of living. It's important to consider inflation when evaluating the performance of your investments and making decisions about your investment strategy. Failing to account for inflation can lead to an overestimation of your real returns and an underestimation of the impact on your long-term financial goals. Historical examples of inflation's impact. Throughout history, there have been numerous examples of inflation's devastating impact on savings and investments. One notable example is the Weimar Republic of Germany during the 1920s, where hyperinflation caused the value of the German mark to plummet, and citizens experienced their savings becoming virtually worthless. People had to carry wheelbarrows full of cash just to buy basic goods, and many lost their life savings overnight. This extreme case highlights the potential for inflation to completely erode the purchasing power of a currency. Another historical example is the oil crisis of the 1970s, where surging oil prices led to a chain reaction of rising costs for goods and services. This period of high inflation eroded the value of savings and investments, leaving many individuals struggling to maintain their standard of living. Wages failed to keep up with the rising cost of living, leading to a decrease in purchasing power for many households. This period demonstrated how inflation can impact various aspects of the economy and the financial well-being of individuals and families. More recently, the global financial crisis of 2008 led to various economic stimulus measures and low interest rates, which contributed to inflationary pressures in some countries. While these measures were necessary to prevent a complete collapse of the financial system, they also highlighted the potential for government policies and economic events to influence inflation rates and impact the value of savings and investments. The importance of beating inflation. To combat the effects of inflation, it is essential to find investment opportunities that offer returns higher than the inflation rate. This ensures that your money grows at a rate that outpaces the rising cost of goods and services. If your investment returns fail to outpace inflation, you are effectively losing purchasing power, even if your investments appear to be growing on paper. One popular way to beat inflation is by investing in the stock market. Historically, Stocks have outperformed inflation over the long term, providing investors with the potential for significant growth. However, it's important to note that investing in stocks comes with risks, and it's crucial to conduct thorough research and seek professional advice before making any investment decisions. Even within the stock market, certain sectors and industries may be better positioned to withstand the impact of inflation. For example, companies that can pass on higher costs to consumers or benefit from rising commodity prices may perform better during inflationary periods. Additionally, investing in real estate or commodities like gold and silver can serve as a hedge against inflation, as these assets tend to appreciate when prices rise. Diversifying your investment portfolio across different asset classes, sectors, and geographic regions can also help mitigate the impact of inflation on your overall returns. By spreading your investments, you reduce your exposure to any single asset class or market that may be adversely affected by inflationary pressures. How to invest during inflationary periods. According to Warren Buffett, the world's most successful investor, certain types of businesses tend to do well during periods of high inflation. These businesses must have two key characteristics: an ability to increase prices easily, even when product demand is flat and capacity is not fully utilized, without fear of significant loss of market share or unit volume. Companies with strong brand loyalty, pricing power, and competitive advantages are better positioned to raise prices without losing customers. Examples of such businesses include consumer staples, utilities, and companies with patented products or services. An ability to accommodate large dollar volume increases in business, often produced more by inflation than real growth, with only minor additional investment of capital. Businesses that can scale their operations easily and have low marginal costs are better equipped to offset the impact of inflation by increasing their revenue streams without significant additional investment. Examples of such businesses include technology companies, software providers, and companies with scalable business models. Buffett's advice highlights the importance of identifying companies with strong competitive advantages, pricing power, and operational leverage, as these factors can help mitigate the negative effects of inflation on a business's profitability and growth potential. Protecting your financial future. Understanding the impact of inflation on your savings and investments is crucial for making informed financial decisions. It is essential to consider inflation when setting financial goals, choosing investment vehicles, and planning for retirement. By staying informed, diversifying your portfolio, investing in inflation-resistant assets, and taking proactive measures to protect your savings and investments against inflation, you can mitigate its negative effects and secure a brighter financial future. Additionally, it's important to regularly review and adjust your investment strategy to align with changing economic conditions and inflationary pressures. Seeking professional advice from a qualified financial advisor can also help you navigate the challenges posed by inflation and develop a comprehensive plan to safeguard your wealth over the long term. Incorporating strategies such as increasing your savings rate, actively managing your investment portfolio, and exploring alternative investments can help you maintain your purchasing power and achieve your financial goals despite the eroding effects of inflation. If you found this video informative and helpful, please like, share, and subscribe to our channel. We'll continue to bring you valuable content on personal finance, investing, and wealth-building strategies. Stay tuned for more exciting videos. Remember, inflation is a silent enemy that can erode your wealth over time. But by understanding its impact, investing in the right businesses, diversifying your portfolio, and enhancing your earning power, you can stay ahead of the game and safeguard your financial future. Let's work together to beat inflation and secure a brighter financial future for ourselves and our loved ones.